If you woke up this morning and took a look at Britain's public finances, then you saw a crime scene. You saw the financial equivalent of the Titanic heading straight for an iceberg while the orchestra keeps playing. You saw how a system built to protect millions of workers is slowly bleeding out, with 2.6 trillion in unfunded public sector pension liabilities, a 138 billion annual state pension bill, and an entire generation, the baby boomers, that has just begun to retire. We're not talking about some developing nation with weak institutions. We're talking about the United Kingdom, the fifth largest economy in the world, a country that is supposed to have one of the most sophisticated financial systems on earth. And you are witnessing the largest actuarial imbalance in the modern history of this country, while the mainstream media calls it manageable challenges. That's a lie. It's a survival mechanism. It's a forced liquidation of promises made to entire generations. And it's the beginning of the end of the pension system as we know it. Let me describe the crime scene to you. On 17th of April 2025, the Academy of Life Planning published a detailed analysis of the UK's public sector pension deficit. No press conference, no television announcement, a blog post on their website. The numbers showed that the total liability for public sector pensions stands at a staggering $2.6 trillion. That's 100% of GDP. And the mainstream media buried it on page 12. That's not financial journalism. That's the language you use just before you set the markets on fire. Within weeks, independent economists began analysing what the official data hides. This isn't a gradual slowdown. This isn't a gradual decline. It's a structural collapse. The algorithms detected the demographic mismatch before any politician had even read the full report. By November 2025, the Office for Budget Responsibility confirmed that the triple lock alone will have added 15.5 billion to annual state pension spending by 2029-30. That's not normal volatility, that's a regime change. That's what happens when a system stops being sustainable and starts surviving. And here's what they're not telling you. Britain has 12 million people receiving the state pension every month. The full new state pension will reach £241.30 per week from April 2026, or $12,540 at the 7th per year. Total state pension spending reached $138 billion in 2024-25, representing around 5% of GDP. But that's just the tip of the iceberg. The unfunded public sector pension liability, the promises made to NHS workers, teachers, soldiers, civil servants, and police officers, runs into the trillions. According to HM Treasury's whole of government accounts, the total liability for public service pensions stands at around 3 trillion. This includes 2.6 trillion of unfunded public service pension liabilities and 449 billion of liabilities from funded schemes like the local government pension scheme. And that was the deal. Workers today pay for the pensions of retirees today, trusting that the workers of tomorrow will pay for theirs. But that deal has just been torn up and thrown in the rubbish. Before we continue, you need to understand something. The algorithms of the media are trying to suppress this information because it contradicts the narrative of stability that we're being sold. Don't let this data disappear. Let me show you the mathematics, because the numbers are absolutely insane. Britain's baby boom generation, those born between 1946 and 1964, created 17 million births. They were the largest generation in British history, and this generation has just begun to retire in earnest. In 2025, the state pension age increased from 66 to 67, which will be fully implemented by March 2028, but the demographic tsunami is already here. The Office for National Statistics projects that the number of people aged 85 and over could grow from 1.6 million to 2.6 million over the next 15 years. And the Working age population is shrinking relative to the retired population. And here's why that matters. In 1950, there were approximately 5 people of working age for every 1 retired person in the UK. By 2050, it's predicted that the ratio will be 2.1. For some scenarios, the International Longevity Centre warns that the state pension age would need to rise to 71 by 2050 to maintain the current number of workers per state pensioner. At pension age 65, a ratio of 20% equates to 5 workers per retiree, but a ratio of 50%, which is projected for the UK by 2050, means just 2 workers per retiree. Currently, there are 4 people of working age supporting each pensioner in Britain. By 2035, this number is expected to fall to 2.5. By 2050, to just 2. The working population is shrinking. The retired population is exploding. This isn't a pessimistic projection. These are demographic facts that are already written in stone, because the future retirees were born decades ago. When the contributor base shrinks, the costs of importing welfare explode. Public spending on the state pension at $138 billion in 2024-25 is already the second largest item in the government budget after health. The Office for Budget Responsibility estimates that spending on the state pension will rise by around 80 billion plus in today's terms by the 2070s, and over half of this increase is projected to be due to the triple lock. And the UK government has exactly 2 options. They can increase national insurance contributions to defend the system, which would strangle businesses and workers, or they can increase borrowing, which means more debt. But here's the problem. If you increase national insurance contributions, the economy contracts. Labour costs in the UK are already high. The 2025 autumn budget announced that from April 2029, the national insurance contributions exemption for employee pension contributions made via salary sacrifice arrangements will only apply to the first 2,000 pounds of contributions. Every additional point of contribution is a point less of competitiveness. It would trigger a spiral of job destruction. So they have to borrow. They have to issue more gilts. And that's exactly what's happening right now. Let me explain the mechanics, because this is where it gets ugly. The state doesn't simply fund these pensions. The unfunded public sector pension schemes operate on a pay-as-you-go basis, meaning there is no fund of assets which is invested. Instead, contributions from current employers and employees are paid into schemes and used to partially cover benefits to current retirees. As total contributions and the amounts paid to current pensioners may differ, an annual balancing payment is made by the Treasury to schemes to cover any shortfall. In November 2025, public sector net debt was provisionally estimated at $2,927.7 billion, equivalent to 95.6% of GDP, debt levels last seen in the early 1960s. And this debt has more than doubled since the financial crisis. Between 2007 and 2020, it went from around 35% of GDP to over 95%. That's not gradual growth, that's an explosion. This creates a negative liquidity cascade. The government has to issue more gilts to finance these obligations. Investors see UK debt growing, the gilt yields begin to rise, and suddenly the entire British financial system is bearing the weight of a pension system that cannot sustain itself. And the data proves that this is already happening. Government borrowed $132 billion in the first 8 months of 2025 to 26. This is $10 billion more than during the same period of 2024 to 25. The cost of servicing the debt was $106 billion in 2024 to 25, which is 8.2% of total government spending. The government is now spending more on debt interest than it does on defence, transport and public order combined. Total UK government debt rose above 2.8 trillion in the 2024-25 financial year, up from 2.69 trillion the year before. The Adam Smith Institute warns that Without policy changes, public debt could climb to 330% of GDP by 2075. Let me contrast this with what other countries are doing, because this is the geopolitical angle no one is talking about. The Netherlands has pension funds that are fully funded, with assets backing their liabilities. They've managed the demographic transition by building up reserves over decades. Japan, facing an even more severe demographic crisis, has aggressively incentivized delayed retirement, with bonuses of over 40% for those who extend their working life to age 70. Denmark is increasing its state pension age to 70 by 2040. These countries saw the problem coming and acted. Britain doesn't have that luxury. Britain is being forced to patch the system in real time, while the demographic wave is already breaking. And here's the part that should frighten you. According to former Chancellor Sir Jeremy Hunt, the value of the unfunded public sector pension liability is about 2.4 trillion, around 100% of GDP. It means that, in future, taxpayers will have to fund more than $50 billion of pensions every year. That's particularly unfair on younger taxpayers. They are already facing the pressure caused by an aging population in which there are fewer workers to support every retired person. But on top of that, they are also having to fund the pensions of public sector workers, because, with the honourable exception of local government, the state has been spending rather than setting aside pension contributions. Let me explain exactly how the markets will exploit this. The UK gilt market is one of the largest in the world, trillions of pounds in bonds outstanding. But liquidity isn't evenly distributed. Most of the volume happens in the most recent issues. When institutional investors detect a growing risk of default or restructuring, the algorithms recognize the flow. They see the size of the problem. They see the urgency and they front run. They start selling UK gilts, buying credit, default swaps, positioning for a price collapse. It's a feedback loop that accelerates until something breaks, and something will break. The Bank of England has an implicit target for gilt yields. They don't announce it publicly, but the algorithms reconstruct it from the bank's balance sheet operations and its emergency facilities. If UK borrowing costs spike too high, if investors demand yields that are too elevated, the Bank of England will have to make a decision. Let yields run and risk a deflationary shock to the British economy, or intervene and buy gilts to cap yields, which means restarting quantitative easing and admitting that inflation isn't under control. Both options are catastrophic. If you let yields run, mortgage rates go to 8%. Corporate borrowing costs explode. Zombie companies that have survived on cheap debt start to default. The credit market freezes. The FTSE crashes. If you restart QE, the pound loses credibility. Gold explodes. Bitcoin explodes. Inflation. Expectations become unanchored. And foreign holders accelerate their exit from UK gilts because they know the Bank of England will simply print its way out of the problem. And here's the part that makes this worse than a normal crisis. Britain is supposed to be a stable, developed economy with world-class financial institutions. If Britain enters a debt crisis, it's not like Greece in 2012. Britain is too big to be bailed out by conventional means. Britain is the 5th largest economy in the world. If Britain has problems, the entire global financial system trembles. When a major economy has difficulties, it's not external aggression. It's internal desperation. And desperation is contagious. If Britain has to cut pensions to stabilise the accounts, what signal does that send to Italy? What does it signal to France? What does it signal to every other country with declining demographics and generous pension promises? It signals that the Western welfare state is no longer a safe haven. It signals that everyone should start thinking about their exit strategy. And when everyone thinks about the exit at the same time, you get a stampede, you get a liquidity cascade, you you get force majeure declarations from institutions that can't absorb the supply. Let me do the math live to show you the scale of this crisis. The monthly state pension bill is approximately 11.5 billion. That's over 138 billion annually just for state pensions. Add in public sector pension payouts, and we're looking at over $190 billion per year in pension-related spending. National insurance contributions and other revenue sources cover only a portion of this. The structural deficit has to be covered by borrowing. The OBR projects that the triple lock will add 80 billion to state pension spending by the 2070s in today's terms. If economic volatility continues, the triple lock could cost an extra 1.5% of national income, or 44 billion in 2025-26 terms. On top of this, let me tell you what the Treasury is actually doing behind the scenes, because the public communication is sanitized corporate language. They're launching the third independent review of the state pension age, which aims to consider whether the rules around pensionable age are appropriate. They've revived the Pensions Commission to examine the long-term future of the UK pension system. In July 2025, the government announced that without action, tomorrow's retirees are on track to be poorer than today's. Nearly 15 million people are under saving for retirement. 45% of working age adults are failing to save anything into a pension at all. That's kicking the can down the road. That's admitting they can't pay. The last time Britain faced a genuine pension crisis was when Robert Maxwell stole an estimated 400 to 800 million from the Mirror Group pension fund in the early 1990s. That led to major reforms. But today, a far greater scandal unfolds not in the shadows, but in broad daylight, with little public outcry and zero accountability. And here's the geopolitical twist that no one is talking about. Britain is being partially pushed into this position by Bank of England policy. For years, the Bank of England kept interest rates at historic lows. That created the illusion of sustainability. Government could borrow cheaply. Pension deficits seemed manageable. When the bank started raising rates in 2022 to combat inflation, the cost of refinancing UK debt started to climb. Interest payments on the national debt, which had been manageable, started to bite. In September 2022, the mini-budget crisis under Liz Truss showed how fragile the system is. Gilt yields spiked. Pension funds nearly collapsed. The Bank of England had to intervene with emergency bond purchases. It's a whiplash, and Britain is trapped in the middle, trying to manage a pension system that's being thrown around by monetary policy that has nothing to do with British demographics. This is the hidden cost of being a major financial centre. The UK exports its monetary policy to the rest of the world through the City of London. When the Bank of England raises rates, emerging markets suffer. When the Bank of England cuts, asset bubbles inflate globally. And when monetary policy collides with the survival of the British welfare state, Britain has to choose. And Britain is choosing survival. They're choosing to maintain pensions at the price of indebting the country. They're choosing present social peace at the price of future collapse. And that choice has consequences for every Briton who thinks their retirement is guaranteed. Let me give you another historical parallel. In 2008, Iceland's banking system collapsed. The country's three largest banks had accumulated debts worth 10 times the national GDP. When they failed, Iceland had to be bailed out by the IMF. Pensioners saw their savings devastated. The currency collapsed. It took years to recover. That crisis started with a small country. Imagine what happens if the crisis starts with Britain. Britain is a G7 nation. British banks have trillions in cross-border exposures. British institutions are deeply embedded in the global financial system. If Britain's pension crisis escalates to a sovereign debt crisis, the contagion will make 2008 look like a warm-up. and the UK government no longer has the same tools. They've already expanded the Bank of England's balance sheet to historic levels during COVID. They've already done quantitative easing. The ammunition is spent, and the next crisis will require even more intervention, which means more currency devaluation, which means more inflation, which means more desperation from British pensioners who watch their purchasing power evaporate. It's a death spiral, and we are in the early innings. The baby boom retirements have only just begun. State pension spending is only now starting to show structural weakness. The dependency ratios are only now starting to deteriorate. The algorithms are only now beginning to position for the regime change. And the mainstream media are still telling you that everything is fine, that this is just normal volatility, that the government has everything under control, that you should keep calm and carry on. You need to understand this. When this crisis goes kinetic, when the forced liquidations accelerate, when the benefit cuts start cascading through the system, you won't have time to react. If you wait for the television to tell you what to do, you're too late. You need to be ahead of the curve. Let me walk you through the timeline of how this escalates, because this is not a one-day event. It's a multi-year process. Phase 1 is where we are now. Silent pressure. The state pension bill grows by 4 to 5% per year. The government covers it with borrowing. The debt accumulates, but the media ignores it. Experts warn, but are dismissed as alarmists. Phase 2 is when the deficit accelerates. The baby boom retirements hit their peak. Pension spending exceeds 160 billion annually. National insurance contributions can't keep pace. Borrowing has to increase dramatically. The markets start questioning sustainability. Gilt yields start widening. Phase 3 is when the bond markets intervene. Rating agencies threaten downgrades. The Bank of England hints that it can't keep buying gilts indefinitely. There's talk of conditions. There's talk of memoranda. There's talk of the word nobody wants to pronounce. Austerity. Phase 4 is when the system can't keep kicking the can. Pensions have to be reformed. The state pension age has to rise beyond 67. The triple lock has to be abandoned. The pension credit thresholds have to be tightened. Pensioners take to the streets. There's protest, there's social instability, there's governments that fall, and the baby boom generation, who work their entire lives trusting in the system's promises, discovers that those promises were a mirage, funded by debt. Let me give you the comparison with Argentina, because this is what happens when a country loses control of its welfare system. In the early 2000s, Argentina had a severe debt crisis. The government defaulted on $100 billion in bonds. The peso collapsed. Pension savings were converted to devalued currency overnight. Bank accounts were frozen. People couldn't access their money. Retirees who had saved their whole lives saw their savings wiped out. That crisis shook Argentina for a decade, and that was an emerging market economy. Imagine what happens if Britain, the issuer of one of the world's major reserve currencies, goes through a similar crisis. There's no higher authority to peg to. There's no IMF bailout large enough. There's no lender of last resort for the lender of last resort. And that's why the deterioration of the British pension system is so significant. It's not just about 330 billion in unfunded liabilities over the coming years. It's about the signal it sends. It's about the precedent it sets. If Britain, one of the pillars of the Western financial system, has to brutally cut pensions to survive, what does that say to Italy? What does that say to France? What does that say to every other holder of Western sovereign debt? It tells them that the Western welfare state is no longer sustainable. It tells them that fiscal policy is out of control. It tells them that central banks are trapped between inflation and deflation with no good options. And it tells them they should start planning their exit. Let me show you what the smart money is doing. because this is the part that the retail investor doesn't see. Pension funds are diversifying out of gilts into alternative assets. Institutional investors are increasing their positions in real assets: gold, commodities, infrastructure. The data shows that central bank gold purchases reached a record in 2023, over 1,000 metric tons per year. That's double the historical average. They're not buying gold because they love shiny metal. They're buying gold because they no longer trust fiat currencies. They no longer trust public pension systems. They're diversifying their reserves away from pound and dollar denominated assets. And the really sophisticated players are looking at silver. Silver is the most undervalued asset in the monetary metals complex. The gold to silver ratio currently sits at 85.1. The historical average is 60.1. During monetary crises, that ratio compresses to 15 to 30.1. If we return even to a 60:1 ratio, silver has to double if gold stays flat. If we go to a crisis ratio of 15.1, silver goes up sixfold. And unlike gold, which is primarily a monetary metal, silver has industrial demand. Solar panels, electric vehicles, 5G infrastructure, defense applications. The deficit between mine supply and total demand is 200 million ounces per year. That deficit is being filled by above-ground inventories, and those inventories are shrinking. At some point, there's no inventory left to draw from, and the price has to rise to ration demand. But you can't buy silver at the spot price. You can't buy gold at the spot price. Go to your local dealer right now and ask what they charge for silver or gold coins. The premium over spot is 3.5 for silver. The premium over spot is 50 to 80 odds for gold. That's the gap between the paper price and physical reality. The physical market is already separating from the paper market. That's the leverage in the system. The COMEX silver contract is for 5,000 ounces. The total open interest is roughly 150,000 contracts. The registered metal available for delivery is around 60 million ounces. The leverage ratio is 12.5:1. That means there are 12.5 paper claims for every ounce of physical silver actually available for delivery. If even a fraction of those contracts insist on delivery, the system breaks down. And that's exactly what's starting to happen now. Slowly, then all at once. The UK pension system isn't heading for collapse. It has already collapsed. They just haven't officially announced it yet. The government's own analysis in July 2025 admitted that without action, tomorrow's retirees are on track to be poorer than today's. A Hargreaves Lansdown survey found that 46% of working age adults don't expect the state pension to be there when they retire. Retirees in 2050 are on course for an 8% smaller private pension income than those retiring today. Nearly 15 million people are undersaving for retirement. This isn't a future crisis. This is a present crisis that's being hidden behind optimistic projections and reassuring language. 2.6 trillion in unfunded public sector pension liabilities. 3 trillion in total public service pension obligations. $2.9 trillion in national debt. $438 billion in annual state pension spending. $31 billion increase in state pension spending projected between 2024 to 25 and 2029-30. 2 workers per retiree by 2050, down from 5 workers per retiree in 1950. And the media tells you everything is under control. Britain's pension system isn't on the brink of collapse. It has already collapsed. They just haven't notified you yet. Slowly, then all at once.